Good morning.
Morning.
Welcome to the investment meeting of the Teachers Retirement Board for September 8th, 2022. I'll start by calling the roll. Brian Berge,
Shimon Ray for the mayor's office.
Thomas Brown,
Present. Good morning, Patricia.
Russell Buckley,
On behalf of Panel for Education Policy Chair, Dr. Angela Green, and Interim CFO Benjamin Schambach. I'm here.
Allison Hirsch,
Here on behalf of Controller Department.
David Kazansky,
Present.
Deborah Penny.
Present.
We have a quorum. Turn it over to you.
Thank you so much. Thank you. Good morning, everyone. Welcome
Good
back.
morning.
Happy first day of school to all of our public school children and teachers. We're going to start with a welcome and a little opening by our controller, Mr. Brad Lander.
Thank you so much, Deb. It's really actually so nice to be here on the first day of school. I did a first day of school visit this morning out in Brooklyn at Arts and Letters 305 United, a great public elementary K-8 actually. And pretty special to have the Teachers Retirement System meeting on the first day. And especially this year when, last year's opening, still so full of pandemic anxiety, and not that those are all behind us by a long shot, but still it really felt like, a first day of school today. And just with that immense sense of possibility for these kids. Actually, my favorite was one of the classrooms I went into, the teacher had done first day feels, and the kids all got stickies, and they had columns of like excited, happy, but then there were a few kids who admitted like nervous, scared, anxious, and just what our teachers and our educators and our principals make possible is extraordinary. Like it really is the foundation of our democracy, the foundation of our city's economy, the possibility of making this crazy, wonderful, diverse, messy city work together. Like so much of it comes from what happens in our public schools. So to have the responsibility of making sure that those teachers and educators and administrators know that for the hard work they are doing, they've got retirement security. It just feels like an extra sacred duty today. So it's an honor to be here with you. And it's also, I'll just say, been good I've seen David out on the hustings and a number of as part of the work to make sure those schools themselves are robustly funded and the teachers are getting the work, the resources they need to do the work in the classrooms as we are doing the work to make sure that their retirement security is invested soundly and will be there for them when they need. So fun and an honor to be here. Also great to be here at my first meeting of Teachers Retirement System with Steve Meyer to get to introduce. I know a lot of you got to meet him through the interview process or have met him already, but to do a sort of formal introduction, we're really excited to have Steve on as our new Chief Investment Officer. And I know he takes really seriously the sort of service orientation of working with our partners, our labor trustees, our other public sector trustees, and really understanding that what we're doing is providing kind of stewardship, advice, custodianship, and service to the set of people who are leading and making that set of decisions and trying to do it in the most transparent and thoughtful and prudent ways that we possibly can. I'm also, excited about the fact that we do it with such attention to stewardship of those funds and fiduciary duty and a broad sense of responsibility. So it was wonderful to join with you all just a couple of days ago as part of an effort to make sure through the shareholder action that we're taking a MasterCard, that guns are better tracked. And actually, I understand that the vote at the International Standards Organization about whether to create a merchant category code for standalone gun stores is likely to take place, I think, today or tomorrow. So fingers crossed that goes in the right direction, but whether it does or not today or tomorrow, that action is really powerful and important. We were part of a work together to file a shareholder resolution yesterday at Apple, who have a human rights policy that makes clear that their workers, like our New York City workers, have freedom of association and can make their own decisions about whether they want to join a union, but there's some reasons to be concerned that Apple, for all the good products and good investment returns, isn't following that policy. So we asked them to, we filed a shareholder resolution that would require them to have an accounting for the gap between what their stated International Labor Organization policy is and what their actions have been. And then especially excited today to know that we are almost entirely complete with the direction of this board to divest public equities from fossil fuel reserve owners. I was excited to see over the summer that the American Federation of Teachers is lifting up the work for net zero and prudent climate investment all across the country. And obviously knowing that we here at TRS have been at the forefront of that work, kind of digging in and doing the hard work of identifying those companies, of doing it in a prudent way, of doing it alongside investment in climate solutions and renewables, and showing that it's prudent and responsible investment is really exciting. So honored to be a big part of that. I want to say a big thank you to this board for the partnership and all of that work. I don't get to come all the time, but I always appreciate Allison keeping me very up to date on what you guys are doing. And I think, when I came in now 7 months ago, I made the commitment that Steve is about to pick up, but that we really are taking seriously to understand that it's a role of partnership and that it's the trustees who are making the decisions, who have the responsibility set on the trustees individually and collectively by the members. So I hope you feel like we're living up to that set of promises that we made. If you see opportunities for us to continue to do better, I know that Steve and Allison and I and our whole team in the controller's office at the Bureau of Asset Management are really deeply, deeply committed to. Thank you.
We appreciate that. And on behalf of our members, we really appreciate the work that you're doing with those resolutions, especially the one with the MasterCard and tracking gun purchases. Mike Garland has been doing an awesome job with the proxy committee, right in line with the teachers, what they feel and what they're committed to. And so we appreciate that work. So thank you. So I guess we are ready to continue. So we're going to go to the quarterly performance and Steve, you are on deck.
Great. Thank you very much. And good morning, everyone. So I'm actually going to go a little out of order. I'm going to give a little bit more of a market update and
Don't mess up my order now.
Sorry.
Steve.
I can move around.
First impressions, all right.
Well, given the current circumstance in the market, it probably makes sense to talk a little bit about what's going on in the world, context around performance. So again, thank you. I'm thrilled to be here. I should also, full disclosure, I should mention that I'm originally from New York. I grew up in New Jersey. My wife's from Brooklyn, and my wife is actually a school teacher who did her graduate school training here in New York City as well. And my mother was a school teacher as well. So I'm more than happy to be here. I'm going to give you an overview of what's going on in the market, but I'm also going to consistently try to provide you with a couple of themes that recur and we should always be mindful of as we help you manage these pension assets. And firstly, that's the we're going to have a focus on long-term outcomes, the benefits associated with diversification of investing, viewing the world through a global lens. The U.S. is not an island, and there's a lot going on in the world now that's impacting currency, capital flows, and our domestic markets as well. And lastly, investing consistently over time, as opposed to trying to time the markets. On the next slide, Kate, I think one more, please. This is actually a headline of an article I saw a little over 2 years ago that really caught my eye. And what it emphasizes, this is a sincere article, it emphasizes the long tail that these pension promises hold. This one happened to have been 155 years. And this woman, Irene Triplett, was actually the daughter of a Civil War veteran who fought for, ironically, both the South and the North, retired with a pension. And as a pensioner with income in the 1920s was considered hot property. And he married a woman that was 50 years younger than him and fathered Irene at the healthy old age of 83. And Miss Triplett actually lived until she was 90 years old. So it really gives you a sense that we have the luxury to think on a long-term basis as opposed to worry about every little thing in the markets. The next slide is actually one of my favorite charts. This is the Cowen Associates periodic table of investment returns. And I think this does a great job demonstrating the variability of individual asset returns over time. It's very hard to read, but I think it still makes the point that diversifying holdings across assets and strategies makes sense. I'd say the other thing that I take away from this slide, and I'm sure that the consultants in the room have picked up on it already, the upper left-hand corner, you can see emerging markets actually outperformed for 5 years pretty dramatically. And that was associated with the BRICS, Brazil, Russia, India, China, and South Africa, and the buildup of sale of commodities, also in China ahead of the Beijing 2008 Olympics. And that would have been an interesting theme to have known about or to forecast it beforehand and position accordingly. A full disclosure, you can also notice the next year was the worst performing asset class, the orange way down at the bottom, and then next year was up 78%. So volatility, but again, you never know which asset class is going to outperform. On the next slide, again, this is just, I think this is from here at the United Nations in New York City. Your plan's investment portfolio is invested in both US and international assets, both private and public. Our domestic economies, as I said earlier, and markets are impacted by things that occur beyond our national borders. And I'd say first on that list would be pandemics, followed by technological innovations, monetary policies at central banks, the impact on currency valuations, trade flows, and country competitiveness, geopolitical developments, and we're feeling some of the pain there associated with the war in Ukraine. We also are impacted by election results, trade pacts, and defensive alliances. Climate change preparedness is really having an impact on capital flows, investments, as well as the physical environment, as well, and the demand for raw materials. And again, this just is put this slide up to emphasize the fact that the U.S. is not an island and that we're part of an integrated global economy and society. The next slide, I believe you've seen this slide before very recently, and I suspect it had a title that talked about the lost decades. And it talked about periods of time where over 10 or 12 or even more years that the 60-40 portfolio was flat. And the most recent time would have been 1966 to 82. I actually take something different away from this slide. I think that what it shows you is that it's time in the market being a consistent investor as opposed to trying to time the market, which no one actually can really do well. Very, very, very few people. But when I look at it, I look at the gradual upward shift over 120 years to the right in terms of wealth creation. Again, being part of the markets, being beneficiaries of innovation, growth in the US and global economies, the whole trend of globalization that kind of ramped up in the 90s, labor force productivity growth, as well as increased standards of living around the world. We want to be part of that consistently. The next slide, Kate. Moving on to our economic and market update. Inflation is top of mind these days, both here and abroad. And I'm sure if you open any periodical or even watch the local news, you'll see that inflation levels are near 40-year highs, which is certainly a problem for the Fed. Our economy is emerging from the global pandemic and undergoing significant major transitions called the post-pandemic headwinds. We see increasing demand for goods, services, and experiences, while supply still lacks, pushing prices higher. We've also seen a pretty dramatic shift in monetary policy regimes, both here and abroad, from loose to very tight, with higher official interest rates and quantitative tightening in terms of balance sheet reduction. Again, here in the United States, a little less so in Europe. We continue to see supply chain bottlenecks. A lot of those are associated with China's zero tolerance for COVID and their policy of lockdown. We've also seen pretty dramatic shortages in labor that are pushing wages higher. And lastly, we've seen an increase in demand and price pressures on energy and commodity prices. A lot of that has to do with the Russian invasion of Ukraine. On the next slide, again, just emphasizing the point of inflation around the world. These levels of inflation on the left at 6.8% in June, PCE here in the States. CPI in Europe for July was 9.1, and CPI in the UK is over 10%. and it seems to be going much higher. That economy, I should say the European and UK economies are really suffering from the increased pricing pressures on energy in particular. And what's going on in the marketplace has really pushed inflation outcomes well beyond and well above Fed, ECB, and Bank of England expectations of a 2% inflation target. The next slide it just looks at a recent University of Michigan survey, which indicates that there are high inflation expectations, which are now over 5%. Again, this is a survey. I think the good news also, as you can see up top on the left, on the right-hand side, it's come off the boil a little bit. And the Fed's real concern, and I don't know if you saw him, he was on the screen this morning at 9 o'clock. He actually was talking about the concern about inflation expectations becoming embedded and harder to shake loose and placing consistent price pressure on wages and impacting consumer behavior. The next slide, getting back to oil and commodity prices, this is a slide of the West Texas Intermediate crude oil spot rates. And you can see that they've pulled pretty significantly higher this year. They were over $120 per barrel of oil. It's actually come off significantly. This chart has it, I think it, can't see that, but in the upper 80s, and it's actually at $82 per barrel today on recessionary fears. As the Fed is more aggressive, the ECB is more aggressive, and other central banks of the world tighten, there's increased concern that there'll be a recession at some point. On the next slide, here we're looking at employment. In July, the US employment rate was 3.5%, a 50-year low. And it's moved slightly higher in August, up to 3.7%, probably for good reasons, and that there's more people joining the labor force now and looking for work. The participation rate now, you can see that's indicated on the left-hand side by that yellow line up top. Participation rate is now 62.4%. Pre-pandemic, it was 63.4%. We're still down over 2 million workers in our domestic economy. Again, also contributing to price pressures on wages. And the shortages of workers has also made it very difficult for employers to attract, retain, and hire workers in this environment. We also see demographic shifts, including retirements. And there's been, since the pandemic, 2.1 million excess retirements above what was expected. We also see low growth rates or birth rates in the States, which I think takes a longer period of time to adjust, probably 20 to 25 years. But we've also seen a significant decline in immigration trends, which are all made worse by the COVID pandemic. On the next slide, this is what's referred to as the misery index over the past 30 years. And I don't know if you remember this. I remember this from being a high school student in the 70s. The misery index is simply the CPI inflation plus the unemployment level. And if you look on the right-hand side, you can see it popped up at the outset of the pandemic pretty dramatically, and that was driven by unemployment spiking. And subsequent to some recovery, it's actually popped up again, and this is almost entirely due to the high levels of inflation. And again, today's misery index really underscores the fact that inflation is a real problem for the average citizen in the United States. A couple of fun facts from a historical perspective, and I love history and financial history. The misery index actually had its highest level under President Jimmy Carter in 1980 at 19.72, and its lowest under Dwight Eisenhower in 1953 at 2.97. The next slide is a chart that really shows the disruption that COVID has placed on GDP growth around the world. These are 5 major economies or zones. And you can see that on the right-hand side that at the outset of the pandemic, the spike down in GDP was fairly universal, and the recoveries have been much more idiosyncratic, depending upon monetary policy, fiscal policy, and actually vaccination protocols around the world. I think the other interesting thing about this slide is you can see the blue line that is just below 10%, probably about 8.5% over time. That's China's economy. So for the prior 8 years, I guess, before the pandemic, it was really an engine of growth for the entire world economy. And that's certainly come off. And with their zero tolerance COVID protocol, it is really stretching that economy. And you can see that the economic growth right now in China is pretty flat. And it's even slightly negative here in the States. I'll talk a little bit more about that in a moment. The next chart actually shows the details of the last 6 quarters in terms of US GDP growth. On the far right-hand side, you can see there's more of a downdraft than there is uplift. And that represents that the US economy in the first calendar quarter of 2022 was down 1.6%, followed by down 0.6%. The rule of thumb typically has been if you have 2 consecutive quarters of negative GDP growth, you're in a recession. I don't think that applies now because the employment market is just so strong, as is the consumer. The consumer balance sheets are strong. You can see the gray bars, they're all positive. That represents consumer spending. So it's come down a little bit, but it's still pretty robust. This next slide actually talks about the Federal Reserve's dual mandate. And when I was preparing slides for this meeting, I was surprised to find this out. This is actually specific language that was taken from congressional legislation from 1977 that said the Fed's mandate was to achieve maximum employment, stable prices, and moderate long-term interest rates. I count that as 3 mandates. But I guess the conventional wisdom is that stable prices would lead to moderate long-term interest rates. So they kind of shorten it, and now it's just a dual mandate. And actually, Chair Powell was on the screen today answering questions, and someone said, are they in conflict with one another? And he said, no, he still thinks that they're useful. I would say a couple other things. Fed Chair Powell has recently stated his resolve to fight inflation and get it back to the 2% target level, even if it results in higher unemployment. And at Jackson Hole at the end of August, the economic symposium, he said that fighting inflation will bring some pain to businesses and consumers. And there's a lot of talk about will the Fed be able to achieve what's referred to as a soft landing or a reduction in inflation to that target level without causing a recession. And the fact that they're going more aggressively in terms of raising rates in a short period of time increases the risk of a recession. And the average recession results in an increase in unemployment of 2% or higher. So that's a real challenge for the Fed at this point. The next slide, and I have to admit, these are 2 of my favorite slides. The top slide actually shows 30 years of federal fund rate changes, hikes and cuts. And as a general matter, since 1983, it's a slightly longer period than it's shown here, the Fed has increased interest rates 86 times. 75 of those hikes have actually been less than 50 basis points, meaning 25 basis points. They can't say that with any certainty because I don't know if you remember, but before 1992, they never told you how much they were cutting. They changed their open market activities to reflect that. I think this also underscores the fact that this year's hiking cycle, the Fed only began coming up the 0 level at March plus 25 basis points. And they've raised rates subsequent to that, 50 basis points, which is unusual. 2 subsequent hikes of 75 basis points, and you can see that on the far right-hand side. The last time they hiked 75 basis points was in 1994. And if you remember, that caused all sorts of problems out in California with inverse floaters and Orange County defaulting on their debt. The market's still currently pricing in a 75 basis point rate hike for September 21st, followed by another 50 and another 25 in November and December, respectively. So the expectation is at the end of the year, you'll see short-term official interest rates in the range of 3.75 to 4%. And that's pretty tight relative to where it's been. The slide on the bottom is the Goldman Sachs Financial Conditions Index. And that actually reflects, you see that slope up to the right on the far right, and then reflects tightening financial conditions. And the index actually looks at the target Fed fund level, which is moving higher, the trade weighted exchange rate, which is moving higher, the S&P 500, which is moving lower, investment grade corporate bond spreads, which have slightly moved higher, and 10-year US Treasury yields, which have moved dramatically higher. So stay tuned. I think there's a little bit more hiking and a little bit more financial condition tightening. And then my expectation is the Fed will be at higher levels for a longer period of time, which will be pretty challenging for the economy to avert a recession. On the next slide, higher US official rates and quantitative tightening and tightening monetary conditions have also caused the US Treasury yield curve to shift higher. And I'm sorry if this is maybe too technical, but I love this stuff. You can see where it started out a year ago, and the low blue line and how low interest rates were and how relatively flat the yield curve was in the short end. And then it shifted higher at the beginning of the year, that orange line in the middle-ish. And you can see now on the top line that rates have moved substantially higher this year. And the yield curve is actually now inverted, which is a fancy way of saying that the short rates are higher than the longer term rates. And that reflects a couple things. That firstly, there's no real yield premium that goes with buying further out the curve, but also reflects that monetary policy is moving higher and that at some point there will be a risk of recession and then a reduction in the short rates again. And lastly, on the right-hand side, you can see the 2-year Treasury yield spread to 10-year Treasury yield spread is in negative territory now at about 20 basis points. And that's really kind of an unusual circumstance. On the next slide, it's a look at credit spreads, investment grade and high yield credit spreads. And this impacts your investment grade corporate bonds and your high yield corporate bonds. And this is just a way of looking at the fact that when economic uncertainty increases and the potential for recession increases, it hurts corporate credit directly, but in different varying amounts. So the upper red bar is actually the high yield credit spreads, which I'm glad you can't see the slide because I can't see with or without my glasses on, but I don't think it's correct. High yield spreads right now are about 470 basis points above corresponding US Treasuries. And the investment grade spreads, which are lower, have also moved up a little bit higher at around 140 basis points above Treasuries. And again, that just reflects that there's more uncertainty in the marketplace. On the next slide, this emphasizes, there's a lot of information on here, but I'll point you to what's relevant. This actually points to the fact that the pain in the bond market is global. And I mentioned earlier, at least I thought to mention earlier, US Treasury 10-year yields. If you look on the far right, it's the top, it says year-to-date change or YTD change. Our interest rates right now, as of the time of this print, were 161 basis points higher. But look down the list, these are all major sovereign debt issues in 10 years. They're all up, 1, 2, 200 plus basis points, with one big exception, and that's China. It's the last one on the lower right-hand side. Treasury yields there have actually come down 13 basis points. And that's because they're actually reducing rates. Their GDP growth is flat. Their policy of zero COVID tolerance is really hampering the economy. Right now, I don't know if you read, but a week ago, they closed down their 4th largest city, which took 21 million people out of the marketplace and shut down businesses. And in aggregate across China right now, there are 44 million people that are in lockdown. So that policy is having a negative impact on China's growth. But again, as we saw in that chart earlier, there also had been an engine of GDP growth around the world, which is now hampered. On the next slide, this is really very, very interesting and very unusual. The US dollar is incredibly strong this year. It's trading at 2- and 3-decade highs against several trading pairs or currencies. And this is due to the fact that our interest rates have moved up higher, faster here in the States. We've been, the Fed is, although they may have gotten religion late, they've been fairly aggressive and very aggressive in raising rates. Our economy generally is stronger. We also benefit from having reserve currency status, in particular oil. Everything in oil is traded in dollars. And lastly, flight to quality buying associated with geopolitical risks. Again, Russia's invasion of Ukraine and saber rattling by China in the Straits of Taiwan have caused people to move into the US dollar and out of other currencies. There's a couple of impacts worth noting about the strength of the dollar. Firstly, it lowers earnings for US companies that have operations abroad. So as they sell products in the UK in pounds, and repatriate those dollars for reporting purposes in the States, they're at lower levels because the pound has lost value relative to the dollar. It also lowers our competitiveness because as we export, because the dollar is so strong, our products are less competitive. They're more expensive abroad. And lastly, and I'm trying not to be so down, there is some positive news. It actually lowers the imported inflation. That for imported goods, because of the strength of the dollar, we buy them at slightly lower levels, which helps the Fed. The next slide. and I won't belabor the point, but I just think this is fascinating. The euro versus the dollar, the pound versus the dollar, and the Japanese yen versus the dollar, at over 20-year lows, meaning the dollar is incredibly strong, and this is highly unusual. And everyone talks about the euro in particular. It's at parity with the dollar today. Each euro buys $1, whereas back 15 years ago, each euro bought $1.58.
It was that high.
The next slide, and now we're moving into more of the meat around investments. These slides are from the past 30 years. And on the left-hand side, it actually shows volatility, the volatility index, or the VIX, which is derived from S&P index options pricing. It's fancy, but what it really shows is that the volatility of stock prices has picked up. This is referred to also as the Wall Street Fear Index. And the higher it is, the more fear there is in the marketplace. And there's a saying, and it's pithy, and I don't know if it really impacts how we make investment decisions. Saying anyway goes, when the VIX is high, it's time to buy. And when the VIX is low, it's time to go. And that basically means be a contrarian. When there's more concern and more uncertainty in the marketplace and more volatility, you're better to step in. On the right-hand side, this is a similar slide, but it shows the MOVE index for bonds. This is the Merrill Lynch, I have to look this options volatility estimate. And similarly, it looks at options pricing on 2s, 5s, 10s, and 30s, treasuries, and you can see that's moved up pretty substantially as well. On the next slide, talking about general market returns, the left-hand side actually shows that over the past 20 years, equity index gains have dominated. And if you look at that cluster of returns between 0 and 10%, that's for US, non-US, and Russell 3000 broad US stock prices. So generally, there's an uplift associated with investing in equity, certainly over the last 20 years. On the far right-hand side, you can see that all three pairs have been down for the first and second quarter of calendar year 2022. We've experienced S&P's 500, the worst first half performance since 1962, down 20%. And note that the S&P 500 has been up 22 of the last 30 years. It's been down only 8 years. On average, it's up 10%. Worse, it's been down 38%, and at best, it's been up 34%. And on the far right-hand side, this is an even more remarkable slide, I believe, and that it shows the Bloomberg Barclays aggregate index, and it is remarkably negative recently. Look at on the far right-hand side how far down that is. The U.S. Ag had its worst first half performance since 1976, down 10.3%. 10-year U.S. Treasuries, and I don't know how they calculated this, but I can promise if someone has a question, I'll get the answer. U.S. 10-year Treasuries have had their worst first half performance since 1788. I don't even think the government was issuing debt back then, so I suspect they've used probably New York City bonds or some matter of local bonds as a proxy. I'm looking at the consultant because I have a book on it, but I don't have it here. And I'd say the last point I would make is that the U.S. Ag has been up 26 of the past 30 years. Its best return for the full year was up 18%. Its worst return was down negative 3%. And year to date in 2022, it's down over 10%. So again, these are really extraordinary times. The next slide actually reflects, this is a great slide. It reflects the full fiscal year of 2022. So on the left, that's the second half of calendar year 2021. In the middle, it's the first half of calendar year 2022. And on the far right, that's the results for the full fiscal year 2022. You can see on the left that the year got off to a pretty good start. Obviously, emerging markets, equities have had some headwinds, down 9+%. But the other markets were actually holding their own. There was a dramatic drawdown in stock and bond prices in the first half of this year, calendar year, the second half of the fiscal year, that overpowered in the returns we saw in the first half. And you can see the product is in the far right-hand side, negative returns across the board. There is one exception here, and that's oil. And WTI oil is up 43% for the year. On the next slide, this chart shows the relative outperformance of U.S. stocks relative to non-U.S. stocks and emerging market stocks. And on the left-hand side, that dark line, I can't see if that's dark blue. It looks blue here, but I thought it was black. The cumulative returns for US equities have been very substantially higher than those for in the red developed ex-US and emerging markets in blue. The middle chart actually shows the performance for fiscal year 2022. And again, you can see how it had performed relatively well in the first half and then down significantly in the second half. And finally, the final chart on the right-hand side shows year-to-date, fiscal year-to-date performance 2023. It's really just 2 months of data. And you can see we had a pretty substantial rally in July and then a sell-off in August as well. Now, in terms of performance, so I've set the table, and I hope I've managed expectations down, or at least I try to be fair and honest. It's been a tough marketplace in which to invest. As indicated earlier, public market assets and investments have actually been under significant negative pressure in 2022. Actually, could you go to the next slide, Kate? Thanks. As a result, performance across all public markets was negative for both the second quarter of 2022 and the full fiscal year 2022. And you can see that reflected here. Those two columns that stick out like sore red thumbs reflect those negative performances. The good news is all the 5-year returns, again, thinking with a long-term hat and wearing a long-term hat, thinking from a long-term perspective. In the past 5 years, the cumulative returns have all been positive, and that's relative even in regards to U.S. equities, relative to the expected returns. Those expected returns, I have to caveat that those are over a 10-year investment horizon, and those are based on the capital market assumptions. So we still have 5 years to get above or beyond those levels. But again, U.S. equities have held up and performed reasonably well, irrespective of the recent outcomes. Are there any questions? I should have said that up front. There's no such thing as a bad question, but there might be a bad answer for me, but I'll try to be more transparent.
Now, we've learned as trustees, every question we ask is a great.
You know, it's funny. I've learned that as well now that I'm on the buy side for New York City. My jokes are funnier and
Yes.
better looking. And some things. The next slide, Kate. Actually, it reflects again that the market's been very challenging in all areas. And this is actually the teachers' retirement system's net public market returns by strategy. And we've got the benefit of John Merceburg with us. He's going to go through a deeper dive in equities, and I'll leave it to him to talk about performance in equities specifically. In the fixed income space, on the lower part of the chart, you can see that the performance has actually been challenged as well, again, for the full fiscal year. But perhaps outperforming some of the benchmarks. And again, here, I think the takeaway is with the long-term view, the 5-year returns have been all positive. The one area that really shines is cash. And I say that with a smile because we have a zero allocation. We technically have a zero allocation, but cash is king and is generating positive returns for that period of time. On the next slide, now this is much better news. And I wanted to end on a higher note. These are private market returns by strategy. And you can see that there's been a significant outperformance in the last year for the private equity of 27.5%, real estate core of 31%, non-core of 29%, infrastructure of 17%, and opportunistic fixed income of 4.6%. So the diversification across public and private markets has been powerful. And a cynic would look at this and say, yeah, okay, I see that those private markets have outperformed, but they're not marked. They are marked with a lag. They tend to be less price volatile and less respond less to economic developments in the marketplace. And I met with one of your private equity managers yesterday, and he made the statement that said, yeah, the marks, we don't have to worry about marking our positions to market today because we're not necessarily selling today as if we were liquidating stock. And we can be more selective in terms of when we choose to sell a position we're long. And if anything, that as things start to cheapen up, and Anash can speak better to that, but things start to cheapen up, there's a lot of dry powder in the programs we have that are waiting to be called and then put to work as well. On the next slide, this is actually quarter-to-date performance. And you can see that for the quarter, we've actually outperformed the policy benchmark. The policy target weight benchmark came in at negative 9.43%, whereas the actual plan came in at negative 8.9%. So that's 53 basis points of outperformance. And that's driven by two things: the allocation effect, those over and under weights, plus 30 basis points in that small middle chart. And on the right-hand side, investment manager outperformance, or alpha delivered by our investment managers, at plus 23 basis points. No one likes to see negative returns, but on a relative basis, that's a fairly good outcome. On the next slide, as I mentioned, John's going to talk more about the equity market performance, but this actually looks at the 3-month performance for public markets and the 1-year excess performance for publics as well. And you can see here that it's been a challenging market, probably perhaps more so for equities. I know that John's going to cover that, but fixed income's pretty much performed as expected given the environment that we've been operating in.
Just to make sure I understand this, so we were 12 basis, like our US equities were 12 basis points below, TRS's equities were 12 basis points below the Russell 3000 for the quarter.
Yes, that's exactly right. And the next slide. Again, this shows the strong outperformance associated with the private market holdings for the year. And if you look across, you can see in 1 year, with the exception of non-core real estate, was down a little bit, down 19 basis points below its target. And that index actually is above and beyond what the benchmark is in core by 200 basis points. So not necessarily a bad result. I think the more important thing to look at as long-term investors is that the 3-year, 5-year, and 10-year and since inception numbers are all well above those benchmark targets. And that is a good outcome.
Our private equity benchmark is the Russell 3000 plus 300 basis points?
Yes.
As opposed to some private equity benchmark?
That's pretty standard. It looks at the public stock market plus an illiquidity premium associated with private holdings. But those are the actual benchmarks that are in the investment policy statement. Last slide, I think, or next slide, I should say. It just talks about some of the rebalancing activities that we undertook in the second quarter of calendar year 2022. We had 2 new mid-cap managers come on, and we had the fund. And these changes reflect that we had to raise capital. Bless you. By selling large and mid-cap and some small cap and reallocated into, again, those mid-cap managers. We also had to sell some short-term treasuries to fund that. And then we actually had bought large cap again to rebalance the market cap weighting across the portfolios. Next slide, Kate. All the over and underweights for the public markets are basically within tolerance, or within expectations. It's our job as portfolio managers, and given the targets that you've given us in your asset allocation and the investment policy statements, it's our job to manage to those targets. And we do so very carefully, looking at a couple of things. We look at certainly the transaction costs associated with rebalancing. The targets typically have some variability of 2 to 4% depending upon the asset class around them, but you can see they're all pretty tight to where they're supposed to be. And with that, I'm going to turn it over to Ed Berman, who's going to do a deep dive and a discussion of our risk. It's going to be a little different than I think you've seen in the past.
It's a difficult chair to fill.
It's a difficult act to follow as well, which I seem to get to speak right after him every time.
Yeah.
But thank you. I'm excited to be here.
Hi.
It's always my first time meeting with the board, and we took this as an opportunity to refresh the presentation. New visuals, we'll go over them as we talk. And first, I want to thank the risk team who pulled together the analysis, and specifically Dan Haas. He's now on the line. You know him very well. You met with him on a quarterly basis. And Dan is on standby to correct all of my mistakes I'll be making probably.
Well, welcome to our board. We
Thank
look
you.
forward to hearing.
Can we have first slide, please? So we'll go over the risks of the plan in 2 slides. We'll first focus on the plan at the top level, and then we'll dive into individual asset classes. So for this quarter, the risks for the total risk for the plan stood at 11.6%, almost a 1% change from the previous quarter. You can see this number at the bottom right of this table. But what does this number mean? Should we worry about it? Should we be concerned? Or is it in line with expectations? So we'll try to peel the onion a little bit and kind of think what this number means, what effect this number, what drives it. So broadly speaking, there are 2 main inputs into these levels. It's the markets and the portfolio construction process. When we build a portfolio, the most important decision we make is a stock bond split. How much we'll put into equities and how much in fixed income. So stocks obviously bring us the highest appreciation, the best chance to make the returns, but it also brings the highest risks. So we try to balance it with the fixed income allocation, which acts as a ballast and provides the most optimal risk return profile, which is the efficient frontier. So we capture this in the first column on this table, which we call market portfolio. It's just a standard blend of 60-40, 60% of MSCI ACWI, which is the broadest global benchmark, and 40% allocation to the Barclay US Ag, which is the broadest measure of the US fixed income. The next step in the investment process is the asset allocation process. And this step is captured in column 2, which is the policy benchmark. In this exercise, which is coming very soon, again, we split the stock portion and the fixed income portion into individual asset classes. And you can see them at the bottom of this page, the 11 buckets. This is mentioned, captured by the second column. And the final step in the investment process, which is the actual portfolio, the plan itself. And that's where we do the manager selection. There's some intermediate rebalancing. There's some cash flow needs, all the technicals that go into day-to-day management of the portfolio. So let's start with column 1, market portfolio. And that will give us a handle, a feel of what markets did and the baseline for our analysis. So in the market portfolio, there are 3 main dimensions of risk, which correspond to the 3 main dimensions of how the portfolio makes money. That's equity risk, interest rate, and credit. So the equity risk is probably the most intuitive. It's captured by the equity allocation, and it's 60% by construction. The interest rate risk, which is essentially the time value of money, is measured by so-called interest rate duration. So what is duration? And it's simply a convenient scaling factor that translates interest rate moves into the market value changes. So you can see that for this quarter, the interest rate duration for the market portfolio stood at 2.6 years. And it simply means that a 1% increase in rates means a 2.6% loss for the portfolio. The third and last dimension of risk is credit. And credit represents the risk that the borrowers may not repay the loans, the risk of default. Much like interest rate allocation, much like interest rate risk, credit is measured by duration. Again, it's a simple scaling factor, and duration 1.6 means that a 1% increase in spread levels translates into 1.6% loss for the portfolio. You'll notice that the spread duration is lower than rates duration. It's simply a reflection of the fact that Barclay Act is mostly US government. As a matter of fact, about 60% of Barclay Act is captured by the government. So what does this portfolio mean for the risk levels? You can see them at the bottom of this table in the column 1. So we capture here 2 broad risk measures. First of all, the total risk. The total risk for the portfolio, for the market portfolio, stood at 11.1%. What does this number mean? It means that over the next 12 months, we expect the portfolio to return about 11.1% within this range, plus or minus. And there's about a 15% chance that the returns will be higher than 11.1%, and that the returns will be lower than 11.1%. You can only see that for this quarter, the risk level increased quite significantly by almost 1%. And that's simply a reflection of this extraordinary period. I'll go back to the Steve's portion of the presentation. The equities, as measured by the VIX index, are running at a very high level of risk. As a matter of fact, VIX right now is about twice the pre-COVID level. The action is more dramatic in the fixed income. So the MOVE index, which assesses the volatility of fixed income, runs at about 3 times the pre-COVID level. And as a matter of fact, we need to go back to the global financial crisis days to see the same level of risk in the fixed income markets. So it's not surprising that our market portfolio risk levels ticked up. And that gives us a very nice baseline as we move forward and assess the risk levels to the portfolio. The second measure of risk you can see at the bottom of this table is the beta to the S&P 500. So whereas total risk level is calibrated to more longer term performance, it's a 12-month return, the beta is more of a short-term measure. It gives you a sense of how portfolio will shift with the short-term moves in the S&P. And we pick the S&P 500 as probably the most representative, the most important equity index globally. So among in the entire stock markets globally, the US market captures about 60% of total capitalization. And out of all US equities, the S&P 500 is by far the most important index. So the beta of 0.56 means that for 1% change in the S&P, the portfolio will shift by 0.56. Notice that this number is lower than the 60% allocation.
You said in the S&P?
For the S&P, yes. And that of course includes the fixed income and equity and everything. So you'll notice that this number is lower than the 60% allocation. And why this is so? First of all, it's because of the international allocation. As the S&P moves, you expect international equities to move as well, but not as much, but also the fixed income allocation. So that's why you see the diversification benefit. It's the good outcome. That's exactly the purpose of the portfolio construction process, and that's how we expect it to be. You can only see that the beta is broadly unchanged. It remains steady, and again, it's a positive outcome. Now let's move to the policy benchmark. That's where we adjust for the asset allocation process. So what changed? First of all, you notice at the top of the table that the equity allocation ticked up. We're taking slightly more equity risk. And that's again by construction. That's not surprising. You'll notice that the interest rate duration, interest rate risk, is slightly lower. And this is simply because we take heavy allocation to high yield. Again, it's part of the asset allocation process. High yield tends to be of a shorter maturity, means lower interest rate duration. You'll also notice that the credit spread duration is slightly lower. And that's because we have allocation to the TIPS as the inflation protection, and it's obviously very relevant in the current environment. So what does it mean for the risk levels? Moving to the bottom of the page, you see that the total risk remains almost unchanged. And that's again, it's a positive outcome. We take more equity allocation. We take exposure to high yield, to private markets. We take exposure across the entire capital structure, yet risk levels remains unchanged. It's a positive. That's where you see the diversification in work. You'll notice also that the beta to the S&P is slightly lower, not material, but slightly lower. Most importantly, the changes to the risk levels are entirely in line with the changes to the market portfolio. So again, it gives us confidence in knowing that the changes in risk levels are given by the markets, not by something that our managers did. And again, it's a positive outcome. And finally, we move towards the portfolio itself, to the plan. And that's captured in the last column. There are small differences. We'll go over them. First of all, you'll notice that the equity level is slightly different. We'll have more to say about it on the next page. I won't dwell on it, but it's broadly speaking within the rebalancing ranges, daily rebalancing ranges. You'll notice that interest rate duration is slightly higher. And this is because of our allocation to the ETI program, which take exposure to long-dated mortgages. So it's not surprising. So what does it mean for risks? You see them at the bottom of the table, and you'll notice that the risk level is slightly higher at 11.6%. What drove this change? To some degree, it's the allocation to active managers, primarily outside of the United States, developed markets. But the most important contributor are the private markets. As we take a material allocation to private equity, to infrastructure, OFI, private real estate, it obviously brings high levels of risks. Again, we'll have more to say about on the next page. The beta to the S&P is again slightly higher, not materially, but you see a slightly larger exposure to the S&P. It's not surprising. And here we also bring forward the third measure of risk, active risk. So much like as the total risk level, active risk assesses the excess returns for the portfolio over the benchmark. And what it is quite simply the active risk is 1.8% means that the excess return over the next 12 months is expected to be within 1.8% range, plus or minus. And it is also about a 15% chance that excess returns will be higher. And unfortunately, about a 15% chance that excess returns will be lower. Nothing, there's no free lunch in risks, unfortunately. It's all up and down. So the risk level 1.8% is driven to some extent by the active managers, but by far and beyond, it's the private assets that drive the risks. Again, I'm deferring to the next page, but before we go to the next page, I want to draw attention to the two charts on the right. So chart 1 shows the evolution of the risk measures between these three portfolios over the past 12 months. And you'll notice how well aligned these portfolios are. Everything moves together. Again, it gives me some comfort. It's not something that our managers do. Again, it's a positive outcome, and it means that the portfolio functions as expected. You'll notice that all three risk measures bottomed out around January this year, January, December. And this again is a function of markets. As volatility picked up significantly in the first quarter, second quarter of this year, the risk level started trending up, but the broad relationship between the benchmark and the portfolio remains the same. And finally, the chart at the bottom of this page, chart 2, shows the evolution of active risk, which is the excess returns. Again, the same messaging, very consistent. It bottomed out at about 1.6 around December of last year, and it's been ticking up driven by the higher risk levels in the marketplace. But again, the relationship is steady, as you would hope to see for a portfolio of this size and this level of diversification. So I'll pause here if there are any questions before we move to the asset class risks.
I'm gonna have to leave. I just wanted to chime in one thing, and Allison could follow up on it later, as Ed mentioned and Steve hinted at. And we're looking forward to moving into the asset allocation process in the near future. And you know, part of what we're waiting for and kind of hoping for and working for is that the governor signs the basket clause bill. But she's indicated basically all bills that were vetoed by the prior governor at some point are in a like, let's wait till after the election to deal with them. So I think she's gonna look at them between in November and December. We've done Allison's done a really nice job of rounding up a lot of folks in the investment professional community, in the labor community, in the political community to communicate just that there's a broad consensus that giving us more flexibility makes a lot of sense. That doesn't mean that we would automatically in the asset allocation process take advantage of that flexibility. That will be a decision that the trustees will make in consultation with our investment experts. But hopefully we will have that, and obviously we'll know for sure by the end of the year.
Great.
Thank you all.
Thank you for
Thank
coming.
you. Have a good day.
Thank you.
Can we have the next slide, please? Thank you. So here we dive more into the insights of the portfolio. We'll consider individual asset classes as defined by the strategic benchmark. So first of all, let's focus on the column 1 where we review the allocations. And the message here is that allocations are broadly in line with the benchmark. There are small overweights, underweights, which I'm primarily within daily drifting range. There's one exception here at the bottom of the page, as I'm sure you're all aware, we're running a slight overweight in the private equity allocation, and we're slightly underweight in the rest of the alternatives, private real estate, infrastructure, and OFI. In the next column, column 2, we'll look at the risk levels, total risk levels at the asset class level and the contribution to the portfolio. And actually, the same information is captured in the chart at the bottom of the page. It's a little bit easier to follow. So I'll track mostly the chart instead of the numbers. And I realize this page is a little dense, there are a lot of numbers here, but that's just unfortunately hard to avoid. Risks tend to be about numbers. So focusing at the chart at the bottom of the page, the blue bars represent the portfolio allocations, and the orange bars represent the risk contribution. So several takeaways from this chart. First of all, there's one asset class that punches well above its weight. It's equities. And as a matter of fact, the public and private equity taken together contribute about 85% of the total risk level. This is not surprising. This is actually very typical for a multi-asset portfolio. Risk levels for equities are much higher. Within the equity allocation, the US equities tend to be the highest risk level. And that's first of all consistent with the highest returns from the US markets, but also from a high ratio of technology allocation within the US stocks. So it's not surprising. Actually, the S&P 500 tends to be one of the riskiest indices among global markets. The private equities also comes with high risk, and that's unfortunately the way it is. High returns in high risk. But also look at the fixed income allocation in the middle of this chart, specifically core fixed income and tips. You'll notice tall blue chart and almost no orange. So fixed income provides the diversification. It's a balance for the portfolio. It's how it's intended to be. And again, it's a good outcome. The next column on this page, the chart, column number 3, active risk. And again, just to remind, it's the assessment of the excess returns. There's several takeaways here. First of all, focusing on the public markets, active risks tend to be low. For public equity, it's about 1%, and for fixed income, it's even less. Again, this is not surprising, it's by construction, but there's some areas of risk concentration. In particular, if you focus on the developed market ex-US, you'll notice that the active risk runs at almost 3%. And this is simply a reflection of active nature of our managers, in particular Bailey Gifford. I won't dwell on it much, and then John will cover a lot of it in more details. And the same goes for the emerging markets. But within fixed income, you see that the active risks are low, and that is just simply a reflection of mostly passive nature for fixed income allocations. It's as expected, and it's in line with the portfolio construction process. The numbers get to be much larger at the bottom of the page. That's where we get into private assets. And I hope it doesn't come as a surprise. As Brad just asked this question, we benchmark private assets against public markets. We know they perform very differently. We expect excess returns from private markets to be different, and that's reflected in our risk numbers. So that's not surprising. But what's probably more interesting is to compare risk against returns, because I keep mentioning that risks is a measure of return, right? And that's what captured in column 4, I'm sorry. The first thing that jumps at me in column 4 is the sea of red in the public markets. And I want to connect to the Steve's portion of the presentation, as we just heard. This was probably the most challenging period for the 60-40. We need to go back about 100 years to see similar performance. Obviously, our portfolio is not constructed for this quarter. We're more of a long-term investors, so it's not surprising that performance was challenged for this quarter, just as Steve just mentioned it. But it's interesting to see how well it compared against our risk measures. And by far beyond, it's not surprising. For the US equity allocation, the returns were well within expectation. For the developed markets ex-US, the returns were much worse than expectation. I have to go back to what I said before. There's about a 15% chance that the returns will be worse. We're definitely within this range. This is a unique historical period, and the returns for developed market ex-US, barely given comes to mind, were unfortunately disappointing. The same can be said about fixed income. When extraordinary period, the treasury markets, again, I'm quoting back from Steve, we go back to the 18th century to find a comparable period. So it's not surprising that the returns for the fixed income allocation were worse than expected. At the same time, the excess returns actually performed well. They conform to our model. And you see that the excess returns were well within our estimates. So what it tells us is that the managers performed as we want them to perform. The investment process performed as we expected, but we are at the mercy of the markets. Private markets provided a very useful diversification, and it's at the bottom of the page. This one exception, it's a good exception, private real estate. It performed well and above of our estimates. I hope it will continue, but the rest of the asset classes performed as our model estimated. So I will pause here if there are any questions before we move towards forward-looking projections.
Any questions?
I'm still shocked they have records back to 1788. You said?
Yes, I think it was a grain of salt, but a lot of things changed during this time. Yes, but it's clearly extraordinary times.
I have a quick question. The blue shading on the total risk contribution column. What is that intended to imply across the various asset classes and sub-asset classes? I'm just noticing we got emerging markets 11.9 contribution to total risk. I assume that whole column is intended to sum to 100. The conditional formatting between the 11.9 and say the 0.8 for the tips, for example. I just wanted to try to better understand what that column is intending to convey.
The conditional formatting identifies the asset class within each group, which provide the highest and the lowest allocation.
So it's just max and min.
Right. So it's within each bucket, right? So within equities, within fixed income.
Okay, great, thank you.
And I would say there are no huge discoveries here. And I'm glad to say there were none. So
there were no what?
There were no huge discoveries, no huge takeaways. I would hate to bring this to the table.
Thanks.
If they were, of course, we would have communicated long before this meeting.
Thank you.
I appreciate that some of the concepts that Ed's going through. I think he's doing a great job presenting them, but they are complex. I've been doing this for 38 years. And I'm a certified financial risk manager. And the first time I went through with it, my head was spinning a little bit, but it's the third time for me. And actually, when it's finally soaks in, it's actually really very, very informative. And again, I hope it ties into the portfolio review that we did earlier as well. We had to recruit someone with a PhD in organic chemistry to actually manage the risk for your portfolio.
Physical chemistry.
Well, yeah, I'm not sure it's that important, but unfortunately,
embarrassing.
yes.
In a good way.
Risk, unfortunately, is multidimensional. There's much more to be said. It gets complex, and we'll be more than happy to work with trustees. It may be too much to bring to half an hour, but we're more than happy to answer questions and to provide more color, more background. There's significantly more to be said. This is Mike. Can we please have the next slide? Okay, so here we're looking at the forward-looking projections, as has been the custom. And I think the purpose of this is to highlight some possible evolutions for the markets going forward, but primarily to think about the asset allocation and to see how the portfolio may perform in different environments. And I think as Steve reminds us several times a day, we have no crystal ball, which we don't. And I would say this part in particular is very difficult for projections. I have to say that our conviction level is not very high. And it's probably easy to draw thousands of scenarios. It's more difficult to pinpoint more likely scenarios. So I'm not assigning any probabilities, but this is a reflection of how we see the world and how we see the future evolution. So for the base case scenario, which I would say is medium level of conviction for us, we see a softish landing for the US economy. And I would say it's the time horizon is probably around 6 months. I think it will deteriorate if we project it further than that. But we see the Federal Reserve moderately successful in guiding the US economy to soft landing. The stock market probably has a little bit more downside. The rates remain elevated, but probably more so in the far end of the curve. The inflation will probably moderate as the economy is slowing down, the supply lines getting streamlined. But the credit spreads will remain elevated and slightly widen, and that's driven by the headwinds facing the companies in terms of high interest rates and just the ability to generate profits. And the commodity prices will moderate slightly, driven by a slowdown in the economy and the better supply lines. The negative surprise is probably growing conviction at this point, especially given the recent Powell speech at Jackson Hole. And that's where we see the stock market taking probably deeper downside. So we project maybe minus 15%. We see the rates remaining elevated, moving higher. The curve is inverting further. Inflation, unfortunately, is still a big concern and potentially moving higher. And the credit spreads, of course, widen, driven by the headwinds facing the corporations globally. And of course, connected to the inflation, commodity prices remain high and even higher. So what will maybe the catalyst for the negative surprise? Well, first of all, it's the Federal Reserve over tightening. And we're facing a unique scenario when the Federal Reserve may be tightening in the slow economy. That's not a positive environment. Obviously, the ongoing war in Europe may have significant impact, specifically on the Western Europe. Germany comes to mind, but also France and Italy and other peripheral countries. And we're watching carefully the situation in China. The Chinese economy, again, as Steve mentioned, had been a driver of global expansion up till COVID. It's been performing fairly poorly recently, and it's in the restructuring mode right now. And finally, there's always a chance for a positive surprise, even though our conviction is very low. And I would say the best driver at this point of a positive surprise is more on the policy side. I think it's a question of fiscal stimulus. So Germany just announced recently the fiscal stimulus, and they're discussing restructuring the energy market, capping the energy prices. There's a chance for domestic stimulus, and potentially, as in China, we're watching the forthcoming Congress of the Chinese Party. So there's a chance there will be stimulus in China as well. So in this case, markets may respond positively. You can see an upside in the US S&P 500. The curve will probably steepen, get to be more normal. The front will move slightly down, and the back end move higher. Inflation will moderate, and the credit spreads will tighten. So what does it mean for the portfolio? The results are shown in the two charts at the bottom. So first of all, focusing on the chart one, that shows the evolution at the portfolio level. There's several interesting takeaways. So first of all, the direction of travel is not surprising. I mean, we understand when the stock market tanks, we're probably facing some losses. But the magnitude is interesting. So let's focus first of all on the gray bar, which shows the base case scenario. In the base case, we project the stock market declining by about minus 5%. Notice that the portfolio is declining by minus 3.8%. That's a big change. So we're capturing almost 80% of the equity market sell-off. It's more than would be applied by a 60% allocation. And why that is so? You can see in the chart on the right, the asset classes. The gray bars, they all point down. There's no diversification. Under this scenario, all asset classes perform poorly. The tips detract. The core fixed income detracts. And as a matter of fact, you'll notice that the core fixed income is the only asset class that detracts under any of these three scenarios. Focusing on the positive surprise, again, it performs worse than expected. For a 10% upward drift in equities, the portfolio returns only a plus 4.6 return. We're not capturing full size of the upside, less than 60% as implied by the equity market. And what it is, so again, focusing on the green bars on the chart on the right, you see the tips are detracting. The only portfolio, the only scenario that performs somewhat as expected is the negative surprise. It performs in line with the allocation. So the technical term for this behavior is negative convexity. It's not what you want to see from the asset allocation. And broadly speaking, the reason for that is a fairly unique nature of the current macro environment. We are long-term investors. The asset allocation is calibrated towards long-term. The current environment is anything but long-term. The technical term is a black swan event. It's an outlier. Again, we have no crystal ball. This is just 3 possible scenarios. We cannot even assign probabilities for these scenarios. We're facing probably almost an infinite possible range of outcomes, but we thought that it's an interesting exercise to highlight certain features of portfolios that may not be addressed by the asset allocation. So I will pause there for any questions and discussion.
Any questions for Ed? Good. You can get rid of the negatives.
We will not be doing anything. It is what it is.
I have to ask, when it's Mike's turn, he's gonna have much better news for us.
No pressure.
No pressure. Yeah. Just want positive surprises.
Great. Okay.
Thank you.
Thank you so much.
Thank you.
Thank you.
Yes, John's is
John, you're an
Yeah, you're,
executive,
so you,
yeah.
yeah, you gotta, sorry.
Okay, the website. for
Yes,
this?
so I will introduce this and then hand it over to Kate Visconti on our team at BAM. I think many of you have seen Kate on Zoom as the person who's really running slides and whatnot. She joined the team in February as the Associate Director of Pensions and has been helping just generally project manage and work on all things across BAM and outside of BAM on workers' rights issues. And one of the projects that she spearheaded was an attempt to make our investments more accessible. So, for one, when I became a trustee in January, I look at the monthly reports that we get from State Street that we upload to Convene. I don't understand anything in them. I can't look at them and figure out how much money we have in any given place. I know based on requests and questions that we've gotten from other trustees, I'm not the only one who has a hard time reading those reports. I think Steve told me it was a hard report to understand. And so one of the things we wanted to do was give trustees and really the general public, because this is all public information already, the ability to understand where we're invested and how in a public facing way. So Kate is going to walk you through changes we were making to the asset allocation tab on the controller's website, recommending, and then once we get through the series of September board meetings, we'll make this live on the controller's website, open to any feedback and questions, et cetera, as we go through this. So with that, Kate, hand it over to you.
Allison?
Yes.
I will say that monthly report, there's one useful table in that that's not in anywhere else. Perhaps some of it's in now Ed's presentation. It's page 12.
Page 12. Okay,
Page 12.
I will focus on page 12.
Yes.
I had my eyes
I
were
print
glazed
page
over
12 for
by
every
page
file.
2, so don't
Every
forget that
file.
part.
Put it up.
Okay, Kate.
Okay, thanks.
We've heard your name
Oh,
for so
hi,
long.
everyone.
Now it's nice to hear.
Yes, Kate is.
Yeah, you too, likewise. Okay, so thanks, Allison and trustees. Thank you for your time on this. I'm going to take maybe 5 minutes to give you an overview of this new tool, and I'll walk you through a few examples of how we think you might want to use it. So keep in mind as I'm going through it that all the data presented here is data that is already provided to you in the monthly and quarterly reports, as Allison mentioned. It's also already on our website in PDF form, but like we were just saying, it's a little bit clunky. So this is hopefully going to streamline things for you. So looking at this dashboard as is right now, you're seeing assets under management across all of the 5 systems. So let's hone in on yours. You can do that clicking here. You can also use these filters up here. So this is how you would filter for teachers. So now you're looking at a dashboard of assets under management for teachers specifically. Over here in the top left, you're seeing total net asset value for your system as of June 2022, the end of June. Over here, you're seeing net asset value, but it's broken down by asset class. So private equity, 7 billion, 7.7, so it's units in millions. And then down here in the bottom left corner, you're seeing that same information, but it's presented visually. You can see quite clearly what a large percentage public equity is, for example. And then down here in the bottom right, you see what we think might be the most useful part of this new tool. So this is a list of all of the investments that you have with their corresponding asset class and their corresponding net asset value. Let's walk through an example. Let's say that you are interested in seeing your investments in private equity. So you could again click anywhere that it says private equity, or you can filter up here at the top. Now what you're looking at is a dashboard of your system, and specifically your system's investments in private equity. So you're seeing that you have a total of 7.8 billion in private equity. And then you're seeing down here in the bottom right, all of these private equity investments. So for example, EQT Fund 8, you're seeing has 118 million in net asset value. So let's say you're interested in understanding your fund with EQT more broadly, but you know that you have EQT outside of private equity. So what you might do is remove this filter here. Now you're looking again at your whole system. Go over here to investment name. You can type EQT. And now here you're seeing all of your investments in EQT. And as you select these, the dashboard populates with basically a view of your EQT investments. So you're seeing that you have 512 million in EQT. You're seeing the breakdown across infrastructure and private equity. Down here, you're seeing the proportion. So it's actually almost even for your system. And then over here, you're seeing the investments themselves. So you're seeing all of the individual EQT investments in infrastructure. And then down here, all of the individual EQT investments in private equity and their corresponding net asset value. So maybe the reason that you're interested in this is because a member wanted to know this information for whatever reason. You could go ahead, click this button here. You're seeing export data, and then you can download it. You can receive it as an Excel spreadsheet and do with it whatever you would like. You can do that with sort of any iteration of the tool, any different section. So this is the assets under management side. We also have a new tab, which is going to be asset performance. So over here, as it loads over here in the top left, you're seeing something that we already have on the website. You might be familiar. It's really just one bar at the bottom of this chart that's on the existing website. So now it's a little bit more interactive. This is the fiscal year to date for all the systems. You can click on yours and make it a little bit clearer. And this is right now showing as of fiscal year end June 2022. You can select any month and you'll see fiscal year to date up until the end of that month. So turning to the other two, this chart here and the corresponding graph below. Over here, you're seeing the year-over-year performance for your system. This is for your total portfolio. You can go in and let's say you're interested in infrastructure, filter, and you'll see there the performance year over year for infrastructure. And then you can see down here a chart that will show that same corresponding information visually. So this is a broad overview of the tool. We hope that it's going to be helpful to you, helpful to your members. Like Allison said, it's your data, it's your information. So your feedback is really critical and helpful. So do you have any questions?
So
Sorry, yeah, no, I just wanted to thank you. This is great. But Kate, do you just want to tell the members again? So how would they, so first, when does it become live and how would they get to this? And this is for all of the members. Any member of the public can go on the website? You want to just tell them the website that they would go on?
Yeah, so we can send it to you. It's actually, it's still in development mode, so it's a little bit hard. This is not the right website link. Let's see, I can show you where it is now, if you can still see my screen. So this is the regular controller's office website. You would go, this is the best way I know how to do it at least. Go into overview of the office, down to, this is how you get to really the pension side and BAM side. And then here you have the asset allocation page. So this is helpful. This is what it looks like right now. You basically have your, for all the systems, the total assets under management, and then the breakdown broadly by asset class. And then this is that same information. This is the sum total of what we have right now. And it's on the controller's office website right here. So we can make sure you have that link handy.
Great, thank you.
But so this would be replaced, yeah.
And just to answer the second question, we want to present it to each of the boards. And so the last investment meeting is, I think, the last week of September. So I think the plan would be to go live around October 1st, following the last board meeting.
Great. Well, it's great improvements. Does anyone want to add anything to Kate, or you did a great job?
Yeah, I have one question for Kate. Was the AUM, how, is that in real time? How often is that updated? Because there's, always calls and distributions.
Yeah, so it's a good question, and there is some nuance. If we have Dan on here, maybe he could jump in and provide a little bit of that nuance that I'm not able to provide. But it is updated basically within 6 months, or 60 days of month end, and then sometimes it is happening sooner. So this data is coming from State Street, and basically as soon as they have it, it gets posted. So the latest we have here is July 2022. But maybe if we do we have Dan on? He's probably, Dan, do you want to jump in and provide that nuance that we were talking about? Dan, we can't hear you, or at least I can't.
I was on mute. My apologies. Good morning, everyone. Kate, I think you nailed it. If I understand the process correctly, and I am kind of new to the nuances of this tool, but we should be picking up audited State Street monthly numbers, which are typically posted, I think 18 business days out from month end. A little processing time, I think, on our end, but you would typically see these, with what's called a 5-week lag. They are accounting values. They are as of prior month end, so they would include any valuations to State Street recorded that month, and then the net asset values you see are the most recent valuation for a private equity manager, for instance, that have been adjusted for cash flows. So it's an important nuance actually to note, because when Naj, for instance, gives you a deep dive, or actually any of our alternative assets group heads give you a summary, you'll see that that information is official as of the prior quarter end. So there's a bit of a timing difference in what you'll see posted up here. So sorry, I'm dragging you back into the weeds as always, but happy to answer any other questions you may have.
So it's as recent as the most recent monthly State Street report that posted.
That's correct.
Yes. So nothing will go up here before it goes to you. Any other questions or feedback? If you think of anything, you can send it my way, or via Allison, anything, whenever it comes to you. Okay.
Thank you, Kate.
Sure. Allison, back to you.
Back to Deb. All right, well, I think Yaffa, welcome back, and I'm sure your fingers need some exercise. Yaffa is our amazing stenographer. So, no, and Mike, I know you're just itching to start. We're going to take a little 10-minute break, though, if that's okay.
That sounds great.
Because it's been over 2.5 hours, but we'll take a 10-minute break, and then we'll come back with Mike.
You say it's felt like.
Hasn't it been 2?
No,
Oh, 2
but it's felt like
hours.
it's 12.
An hour.
for passport. Time for passport funds, and I will turn it over to Mike Fulvio or
goodness.
Devin, who's going to.
I'll start out.
Mike Fulvio.
So great to see you all. We will begin with we call it the second quarterly report, though I'll focus in on the numbers to end the fiscal year, which ended June 30th. So if you're following along in the materials on Convene, I'm in page 23 of the quarterly report. And you can see here what's otherwise the monthly report for the plan. The passport funds at the end of June 30th, the diversified equity fund finished with about 15.2 billion in assets. Again, given the challenges we've discussed earlier with respect to markets in the first half of the 2022 calendar year, having a notable impact on performance of these funds, which, as you know, are largely equity oriented. The diversified equity fund returned negative 21.7% for the fiscal year. The numbers for July are better. And then if we're looking through to the underlying composites, a similar dynamic with respect to actively managed equity strategies here in this fund as well. It's a challenging environment for active managers in the first half of this year, and that shows up in the relative results for the actively managed US composite. The non-US equity composite here has the active managers did keep up with the benchmarks all told for the fiscal year. That composite was down about 20.3%. The balanced fund, which ended the fiscal year with about 539 million in assets, that was down about 9.1% last year, roughly in line with the benchmarks. The international equity fund, I noted earlier, the active composite, the diversified equity fund, which again is a mirror of the international equity fund, that fund down 20.7%. The sustainable equity fund last year doing comparatively better to the international equity fund was down about 18.8%. That fund was roughly in line with its Russell 1000 growth benchmark. And again, the US equity index funds following the markets there down about 13%, and the international equity index fund down about 18%. Obviously, as we've discussed in the past, the capital flows into and out of those funds impacting performance, the time-weighted results. So I will pause there and see if there's any questions on the fiscal year results.
Any questions for Mike?
Nope.
Okay.
I will note, because it's in the material, we've been discussing active management and we've have the performance scorecard, if you will. We did meet recently with the U.S. equity managers on the active management side for the diversified equity fund. No material updates there. As far as on the international equity side, there were a couple new flags triggered. We are scheduled to meet with those managers this fall. I'm going to now switch over to the passport funds monthly report for July, which, as we've been discussing, has a nicer bend to it. The diversified equity fund started the fiscal year quite strongly, as did markets. That fund was up about 8% during the month of July, roughly in line with both of its custom benchmarks. The actively managed equity composite, we saw that outperform. We also saw a very modest outperformance from the international equity composite. What we had seen in the first half of the 2022 calendar year was a reversal of what we've been talking about for many years, where growth had been outpacing value. Value made its resurgence in the first half of this year. We actually saw that quickly revert back in July for the month. And since then, it's reverted again. August was another strong month for value, but again, managers keeping up in what was a strong month of July. The balance fund was up about 2.9%. International equities up over 4% for the international equity fund. The sustainable equity fund was up almost 13% in the month of July. Again, speaking to the strength of growth stocks during July. And then you can see the two index funds roughly tracking their benchmarks. The US up about 9.3% and the international equity index up about 3.7%. So I will pause there. Otherwise, we will maybe just very briefly touch upon August. We can skip August. Do you want to make a brief comment or two, Deb?
I think Steve and Ed actually had a very comprehensive presentation that covered a lot of the not so great news for August. But on a high level, for the month of August, we actually had negative results across the board for both equity.
Devin, what did I tell you?
know it. I promise I tried for both equity and fixed income. Although on the positive side, I mean, fiscal year to date is still positive. So I would actually just end it there and pause for any questions, but the details are there.
Questions for Devin?
1 year call was a startling. The 1 year call was a startling.
Yes.
That's,
Not great. So I want to leave some time. We have MFS coming in to speak to, as we do periodically, bring in one of the managers that you work with, have a large relationship with MFS. They're here to present their capital market views. And I guess I'll bring them in now. They have three folks. I was going to say, I'll sit here. Do you mind shifting that on, Stephen? And then we'll put them here if that's okay. I think that's okay with that, if we shift them over.
Or you can sit here, whatever. He doesn't care. I don't care.
I can leave, but I'm on the wrong side of the table.
I'm gonna flip slides, so I'll, actually, I don't have it. They're gonna present their data.
Steve, you're good to see. So they understand.
Yeah, there's three seats left.
Consulting meetings, maybe? Oh, yeah.
Oh, that's.
Susan, you know, just how they
You
explain.
walk.
Yeah, we can talk about it in eons. That'd be nice.
Geez,
So now they're gonna have just hop on the-
in-person meetings again, we'll bring in guest speakers.
So I have to entertain the Gwenna. The Gwenna is coming from South Africa.
Thank you. All right, I'll give you dates.
We have the names of the MFS people.
Okay.
Yep.
I also have some hard copies. I don't know if some people want hard copies or not.
I would like both.
Hand them over.
Good
Would you like a
afternoon.
hard
Yeah,
copy?
thank you so much
I
for
didn't
coming
get
by.
enough for everybody, so I apologize, but.
Does anyone want a hard copy? We send it around.
around. Sorry about that. I should have brought more. I didn't know.
Teacher's love. Okay, now you have it. Thanks.
No problem. Who wants one? I'm good, thanks.
Okay. Why don't you start by introducing yourself to the stenographer who Yafi on the screen, just so she can get your name, and if there's any complications to your name spelling, that would be helpful for her.
Absolutely. So what, do you want me to do introductions?
Yeah.
So I am Stacy Haig. I'm your dedicated relationship manager. Joining me are my colleagues, Rob Almeida, who is our global investment strategist, and Kelly Rouleau, who partners with me on our institutional relationships on the East Coast. She focuses on new business development.
Did you get that, Yafa?
Did you get that?
Yes, I've got spellings. Thank you.
Great.
So. Michael's the driver.
Feel free to tell me which slide you like.
Okay, okay. So maybe I can just start.
Sure.
First of all, thank you so much for inviting us here today, and thank you for your 9-year partnership with us and the trust and confidence you've had with us in the past 9 years in managing assets on behalf of the Teachers Retirement System. We are honored to be a part of your mission in investing the retirement for the New York City educators and their families. So thank you very much. With that, maybe I'll hand it over to Kelly and then we'll move on to Jeff.
Yeah, so thank you again for your time. My name is Kelly Rulo. We're thrilled to be here today with our colleague, Rob Almeida. Rob is a member of our investment management team. He's been at the firm for over 20 years. He's one of our multi-asset portfolio managers. And as global investment strategist at MFS, he's a frequent presenter of perspectives from across our global research platform to our institutional relationships. In our time today, we're going to have Rob share some of those perspectives from our platform and really focus in on what our investors are looking at and what we believe is material for long-term investors and asset allocators such as yourselves. So with that, maybe I'll kick things over to Rob. We have left time at the end for questions, but certainly are welcome and encourage an open dialogue. So if you do have questions, feel free to jump in at any point.
Well, thank you all very, very much for your partnership and for your time today. As both Stacy and Kelly referenced, my name is Rob Almeida. I work inside the investment department. I have a dual role. I serve as a portfolio manager on a couple of strategies, and I serve as the firm's investment strategist. I work, just for context, maybe a little bit differently from other asset managers, strategists, or Wall Street strategists that you might be familiar with. All of those, perhaps those very smart men and women operate from what I call an outside-in perspective, where they have a mental framework for what drives financial assets. It might be an economic view, it might be a financial metric view, whatever it is, they utilize that to construct a view. And then that view is espoused internally to other investors, and they share that externally. I do the opposite. I work inside out. So it's my job, the way I see it, not to give you my view or my team's view, it's to give you MFS's view. So what I do is I sit across the global research platform in our fixed income meetings, in our equity meetings, in our aggregated fixed income and equity meetings, US equity, non-US equity, large cap, small cap, across the board. And I just try to aggregate what I'm seeing and hearing across the organization. And I use that to invest in my strategies and then to give you what is hopefully a very short, very concise, very honest view of how we're thinking about the world. And I'll just do it within 12, 13 minutes. Maybe back up a couple of slides. We go backwards to the front, go one more. Yes, go one more. Yeah, right to the beginning. So my title is very boring, Financial Market Outlook. So it is what it says. But my theme, it's focusing on what matters. And I don't know if this analogy will resonate as your educators, but I have a 18-year-old son who's entering his senior year in high school and of course doesn't listen to anything that I have to say. But as my wife and I just try to message with him as he's preparing for his post-high school education, going to college, and he's working on his essay and all those sorts of things. What matters, right? What's really, because there's so much to be anxious about and worry about. So let's just focus on what matters. And similarly with financial markets, what we've seen over the last 20 years, thanks to the internet, is a systematic democratization of information. And as educators, I think you'll appreciate information and knowledge are two different things. They are not the same thing. We might be more informed, but it doesn't mean we're more knowledgeable. And so as this pertains to financial markets, now performance for the equity market, it used to be on the evening news. Now you're getting it on your phone instantaneously. Jerome Powell sneezed or caught a cold or said something, and that's news that's moving the market. It's not material. It's not important. And if we just simplify what's the purpose of financial markets, every industry has a purpose. What's the value proposition to society? The purpose of financial markets is to allocate society's scarce resources, right? So 300 years ago, kings and queens allocated society's scarce capital. Beginning with capitalism, market participants determined the price of capital, the cost of capital, and who got what and how much. And so, but what's happened in the last few years, we've conflated things like that's on television, GDP, unemployment, inflation. These things matter, and we'll talk about them. I'm not dismissing them, but do they matter nearly as much as we think? Is that really what's important to your pensioners and your investors? So with that, if you could, Mike, we'll jump 2 slides to the, yeah, there we go, perfect. All right, so here's how I've constructed my very short presentation. I want to, I guess, maybe back up my claim that what matters is cash flows. It's profits that drive asset prices. If we think about it in really simple terms, whether it's treasury bonds, New York general obligation bonds, Salesforce.com equity, IBM equity, every financial asset in the world is a stock of wealth. It's a representation of the potential cash flow generation of that asset it's representing. What we're looking at here, the gray line is probably one of the most talked about things in financial markets. That's GDP. That's global GDP. And what I did is I started at 100 coming out of the global financial crisis. And you can see what global growth did for the next business cycle, right? I'm showing you what you already know. That's not the point though. The point is the blue line. The blue line is wealth. That's what I'm using here is profits, global corporate profits. And you can see what global corporate profits did. Again, I indexed it at 100. And over the course of the last business cycle, so from the end of the global financial crisis up until COVID, the lockdowns hit in February 2020, a very long but very weak growth business cycle, equity markets were up 250% worldwide. Investing is simple. Cash flows that drive asset prices, but it's really hard because the future has no facts, not a single one. The point that I'm just trying to make is you can see up until 2020, what did that line do? It was up 260, 270. That's what drives asset prices. The gray line, GDP, that's a flow. It's just a flow. It's just a year-on-year number. It's representative of people spending money, going to a New York Rangers game, buying milk, buying a new car. It's that's the bulk of it. That's 2/3. Then the rest is government spending, companies spending money. So it's 2 different things, but we conflate the 2. We could, Mike, we'll go to the next slide, please. This is probably the most important one. So this is looking at profits just through a slightly different lens. This is profit margins, and this is really what's most important. So the blue line, I guess they're both blue, but the dark blue line is S&P 500, so companies in the United States. The light blue line is outside the United States, so it's companies inside the MSCI EAFE index. The dotted lines going left to right, that's average, which as educators, you know, you're never really at the average, right? It's just a marking point. You're either above it or below it. But the point being is over the last 20 years, profit margins in the United States and outside the United States, beginning, you see there in 2008, 2009, after the recession, accelerated up, just like in the prior slide that I showed you. What matters for future asset prices, what matters for future equity market performance is which way these lines will go. That's it. Everything else is an input. So central banks setting interest rates, and that's the cost of capital, regulation, growth in the economy. Those things matter, but they're inputs into the single output that matters most, which is profit margins. And I guess what I want to share with you and what we are constructively concerned about, maybe that's an oxymoron phrase, is your average profit margin in the United States is around 9%. It's been that way for 100 years. I'm just showing you 20 years because I wanted to show a non-US universe. And you can see Well, about a year and a half before coronavirus hit, margins started to fall. Now, profits are just a function of revenues and costs. So how many cups of coffee is Starbucks going to sell tomorrow, multiplied by the price of those cups of coffee minus the cost of making and selling coffee? It's very, very simple. So the question investors should have been asking throughout the 2010s year is, well, in an environment where economic growth is so weak, there's no inflation, how are profits so high? And if we just take a simple Sherlock Holmes methodologies, remove all possibilities, the one left standing is the answer. It wasn't coming from economic growth. It wasn't coming from selling widgets or raising the prices on widgets. It was coming from companies shifting labor outside the country, offshoring. It was elongating supply chains. It was borrowing money. All these things are reversing now. So here we are, and profit margins were at an all-time high pre-COVID, and they blew through that. I think the simplest explanation for this is a sugar high. Now what's happening? Well, first, what's the price tag for the sugar high? Well, now, unfortunately, some people I can't afford. One in out of 6 households are behind in their utility payments. So we know the cost of it. And what we're going to see, what we believe we're going to see is as growth continues to fade, that's a nice word for slow down. As revenues fade, slow down, as the stimulus fades, wears off, as interest rates go up, what we're going to start to see is those lines fall. That's one half of the equation. The other half of the equation is now the cost of managing or running your business is undergoing what we think is a step function structural change. And I'll highlight in a minute why. So if we could go to the next slide. So what matters is cash flows. The second thing that matters is, well, what's the price of those cash flows? Valuation. Now, for long-term investors like you folks, it's not all that important because you've got 10, 20, 30-year horizons. So the price you're paying today, looking out over 20 years, it's a lot less material. But since we're talking about near-term market, it matters. So you're probably wondering, well, this is an evaluation slide. What am I looking at? So everyone is aware of the massive amount of borrowing that governments made around the world to, let's say, accelerate out of the pandemic. And the numbers are so big, it's just hard to even contextualize. So I'm showing it as a percentage of the economy. So to put it into context, the left-hand axis is the Federal Reserve's balance sheet as a percentage of GDP. That's that blue line. And for 100 years, I'm only showing you the last 20, but for 100 years, it's always been around 4 or 5%. The gray line is the European Central Bank's balance sheet as a percentage of their economy. That's on the right-hand axis. And that's been a little bit higher, but around 8, 9, 10%. Both took a step function jump up during the global financial crisis. You can see that there in 08. And of course, we see what it did over the 2010s with quantitative easing, and then took a massive spike in the last 2 years. Go back to my earlier comments. The purpose of financial markets, it's to price society's scarce resources and allocate them. And what I'm trying to demonstrate here is the cost or the potential implications of stimulus. So at 40% of GDP, or in Europe at 70% of GDP, what's happened is markets aren't pricing risk. Central bankers are. They've made financial markets wildly inefficient. If we could go to the next slide, I'll just give you one last proof point. So this is looking at US small companies. I'm using the Russell 2000 and the Russell 3000. And what this is charting is the number of companies in the indices that were unprofitable. This isn't a perfect metric or perfect, but it's kind of easy to understand. And the point that I'm just trying to make is policies instituted over, not just in the last 2 years, but over the last several years, has inefficiently allocated society's scarce resources and created risks, if you will. And you can see the number of unprofitable companies in the benchmarks today. It's higher than where it was in 2008. It's higher than where it was during the tech bubble in 2009. So how to think about this, and I'll wrap up my comments if we could just go to the next and almost last slide. Okay, so looking forward, I think the prospects for more stimulus are about as low as they can possibly be, because we know the price tag for that. It's 7, 8, 9% inflation. Central banks have to correct their mistake and bring down aggregate demand. They have to, and they've made that very clear. The consequence for that is it's going to expose those corporations with vulnerabilities. And one of my concerns or areas of vulnerability, if I can phrase it like that, this is looking at the cost of people, so wages. And one of the ways that companies were able to generate such high profit margins in such a low growth environment was just simply underpaying people. And what you can see here is that's reversing. I don't need to show this in a chart to any of you that have gone to your favorite restaurant and you've had to wait longer than you should because they just can't staff. And I don't know if you're having a problem with teachers. We have it with bus drivers, school bus drivers in my town. There's a shortage of labor everywhere. And economists want to blame it on the pandemic. If you look back at every pandemic throughout history, at least we went back over the last 1,000 years, the common pattern is a change in attitude, if you will, the great resignation. But the pandemic came at the worst possible time. It was a spark that lit the fire. The kindling was years and years of labor giving share to owners of capital, if you will. So now the US or the European labor, it's now they're pushing back. And this is companies' biggest expense. This is companies' biggest cost. So as growth reverts back to where it was pre-corona, as revenues fall back to where it was pre-corona, what's different versus the last 30 years is cost of resources. And if we could go to the last page. Oh, so to bring it all together, I realize this sounds like a bearish message and an unhappy and an unpleasant one, and it is. However, we are genuinely enthusiastic about this because finally we'll be able to showcase the value of discretionary portfolios. So when something's abundant, it's not worth a lot. So if everyone could run really fast, we all play for the New York Giants, but people with a unique skill get paid a lot because they have something that's scarce. Conversely, when there's something that's non-scarce and abundant, it's not worth very much. And as I showed you in the 2010s, profit generation, margin accretion, however you want to think about it, was massively abundant. Everything's different now. Deflation to inflation, quantitative easing to quantitative tightening, deregulation to re-regulation, globalization to nationalism. All of this increases the cost of doing business. And it's going to expose companies that probably should not have been around as long as they have. And I'll end with the markets, financial markets have and it's going to sound corny, but to me, a really beautiful natural selection process, right? So inefficiencies grow, but then the market wakes up and it kills companies. It killed banks in 2008 because they were behaving or acting in an unsustainable way. It put those banks out of business. I'd offer in the last 10, 12, 13 years, financial markets, investors weren't, their natural selection process was disturbed or intervented by central bankers. And as all that reverses, those companies that hopefully they're in your portfolios, we think they are, that have something that's sustainable and durable, they're going to be worth more, a lot more, because they'll be scarce. That's what we're really excited about. So let me stop there and happy to take questions. Comments?
That was a great presentation.
Oh,
Very
thank you.
interesting.
You made my
Thank you.
day.
Yeah, it really was. It's interesting.
Very different.
Oh, good.
I guess not. Well, thank you. Thank you for joining us. Oh, question?
So I guess are you advocating essentially for like a return to value over growth investing?
That's more, yeah, it's more discretionary over non-discretionary.
Or active versus passive
Yep.
in there, yeah, right, that's what
Absolutely
you're
right.
saying.
Yeah. Yeah, the value growth, just for the way I answer that question, because I get that quite a bit, and it's a very good one. It's often the opposite of what most people think. Growth stocks outperform when there is no growth. Value stocks outperform when there's a lot of growth. So value stocks generally are mature companies that sell widgets. And so the economy's doing better, you're more apt to buy a new car, buy another television, general mature goods. When growth is weak, those companies that have outsized growth
Bless you. Thank you.
become really scarce. So I'm excited. I don't know which will outperform more, but I'm excited for the power of active within each universe.
Thank you.
Thank you again.
Okay.
Very
Thanks.
interesting.
Thanks so much.
Thanks for your questions.
No, appreciate
Thank you,
it.
everybody. I might do it again, so you just say.
All right, I'll be looking forward to it. I'll say you some.
There you go.
I'll hobble.
Thank you.
Thank you. Bye-bye.
Take care.
Okay. So is there anything else, Mike?
That concluded the public session for passport.
All right, yeah, perfect. Anything else for public session before we go into executive? Okay, do I hear a motion to go into executive session?
So moved.
Thank you, Mr. Brown. Do I have a second? Second. Thank you, Ms. Hirsch. Any questions or concerns? Great. All in favor, please say aye.
Aye.
Any opposed? Any abstentions? Okay, we're moving into executive session. Thank you, everyone, for joining us. Okay, welcome. We are back into public session. Ms. Stang, would you please report out?
Certainly. In executive session, you received a manager contract update. We received an update on an investment initiative. We received some preliminary performance results and an in-depth overview of our public equity program. We received presentations on 2 infrastructure investments. Consensus was reached. We received a presentation on an alternative credit investment. Consensus was reached.
Thank you so much. Okay, does anyone have anything else for this meeting? Hearing none, do I hear a motion to adjourn?
So moved.
Thank you, Mr. Brown. Do I hear a second? Second. Thank you, Ms. Hirsch. Any questions? All those in favor, please say aye.
Aye.
Okay, I don't think anyone's going to.
Wasn't so bad, Steve, was it?
No, it was great.
All right, we stand adjourned. Thank you.
Well.